Welcome to the Deep Dive, where we get you smart, fast. Today, we're jumping straight into Intel's Q1 earnings for 2025.
Right. We know you want the real story, like with all waiting through endless reports or corporate speak.
Exactly. So that's the plan. We'll break it down.
Okay, so the sources, we've looked at Intel's Q1 earnings presentation. That's from April 24th, 2025, and also the transcript from their earnings call that same day. Pretty fresh stuff.
Got it. And our mission here is pretty clear, right? Extract the key bits.
Yeah, pull out the absolute essentials, how they did, the big strategy shifts, the outlook, make it, digestible and clear.
Okay, so let's start with those headline numbers for Q1. Revenue was $12.7 billion.
Which is actually down slightly year over year, yeah, like 0.4%. Barely moved.
It is, but here's the thing that kind of jumped out at me. They beat their own January outlook by $500 million. A solid $500 million.
Which is interesting. It's a pretty significant beat compared to their own forecast.
Yeah.
Makes you wonder why the initial guidance was, well, where it was.
Was it just being cautious, playing it safe? Or did things genuinely pick up more than they expected during the quarter?
Could be either, couldn't it? Or maybe a mix. And it wasn't just revenue showing that pattern. Look at the non-GAAP gross margin.
Right, 39.2%. Now, that is down year over year, quite a bit, actually, 5.9 points lower.
True, but again, compared to their January guidance, it's 3.2 percentage points higher than they thought it would be.
It's this pattern, isn't it? Same again with EPS. Non-GAAP earnings per share came in at 0.13 cents.
Down 5 cents from last year, yeah, so lower year on year.
But 13 cents above what they guided for back in January. A big beat versus guidance.
So they themselves said in their executive summary, these key figures were above expectations. It does paint a picture of maybe cautious guidance, or maybe just really strong execution within the quarter itself.
Could be. In their own chart, the one in the deck showing the trend over the last 5 quarters.
Yeah, revenue, gross margin, operating income. You see where Q1 2025 fits into that recent history. Even with those year-on-year dips in margin and EPS, beating guidance consistently is, well, it's something to note.
Definitely tells a story, maybe about managing Wall Street expectations or maybe some genuine momentum.
Or maybe genuine upside surprises in certain areas. Okay, so beyond the top line, how did the different business segments look? They've got this new reporting structure now, which changes things up a bit.
Right, the new structure. So Intel Products is the big consolidated group now. That brought in $11.8 billion in revenue for Q1.
Okay, but that's down 10% sequentially, right, from Q4 last year.
It is, yeah,
Okay.
sequentially down. But operating profit was still pretty healthy, $2.9 billion, which works out to about 25% of that revenue.
And that Intel Products group breaks down into
CCG, that's the client computing group, think your PC chips, and DCII, the data center and AI group.
Okay, CCG first. How did the client side fare?
Client revenue was down 13% quarter on quarter. They mentioned the usual suspects, products, mix shifts, competitive pressures.
Standard stuff in the PC market, yeah.
But they said client results actually met their own internal expectations because the volume, the number of units shipped, was higher. So selling more chips, maybe at lower average prices or just a different mix.
Interesting dynamic. Okay, in DCAI, the data center and AI part.
That was actually a bit stronger, relatively speaking. Revenue there was down only 5% sequentially, and crucially, this segment performed above their expectations.
Ah, okay. And why was that? What drove the upside?
They specifically called out the hyperscalers, the giant cloud computing companies. Apparently strong demand for host CPUs, specifically being used in AI servers, and also for storage compute needs.
So even with the overall product segment dipping sequentially, the data center piece, especially the parts linked to AI infrastructure, showed some real resilience there. That seems pretty important strategically.
Yeah, could be an early sign they're getting some traction in that crucial AI infrastructure space, even with host CPUs.
Possibly. Then we have Intel Foundry, the manufacturing arm. That's the big long-term strategic bet, isn't it?
Huge bet, massive investment. Q1 revenue there was $4.7 billion. That's actually up 8% sequentially from Q4.
Okay, so Foundry revenue is growing quarter over quarter. But what about the profit, or lack thereof?
Still posting a significant operating loss, $2.3 billion lost in Q1, which is, well, pretty much flat compared to the loss in the quarter before. So making more revenue, but the costs are still incredibly high.
Yeah, but that makes sense, though, right? I mean, they're trying to ramp up Intel 18A. That's their next-gen, really cutting-edge manufacturing process.
Exactly. 18A, it's critical for their future. It's supposed to power the first Panther Lake chip designs by the end of this year, 2025.
Panther Lake, right? The next big client chip family. So building out that capability, getting the manufacturing yields up, That just costs a ton of money up front. It's a massive investment cycle.
It's the definition of an investment phase, yeah.
Yeah.
Burning cash now to hopefully build the foundation for future profits. That's the idea anyway.
Right. And finally, there's the all other segment. What's lumped in there?
It's kind of a mix of things. Mobileye, their automotive tech business. Altera, the programmable chip company they're divesting. IMS nanofabrication. Revenue was $943 million. That was down 15% sequentially.
Okay, down sequentially. But was it profitable?
Just about. $103 million in operating profit. Small number in the grand scheme of Intel, but still positive.
And anything particularly noteworthy happening within that all other bucket?
Yeah, actually, a couple of interesting points. Mobileye apparently secured its first major design win for its Surround ADAS platform. That's their advanced driver assistance system.
Okay, significant ADAS win for Mobileye. Good for them. And Altera.
Still on track for that majority stake sale to the private equity firm Silver Lake. And IMS deliveries were apparently better than expected as well.
So, smaller pieces of the puzzle overall, but still important moving parts with their own stories. Does that Mobileye 80s win connect somehow to their bigger AI picture, maybe? Like this physical AI concept they mentioned?
That's a really good question. How all these different pieces fit into the overarching strategy. It's definitely something to watch as things evolve. But speaking of strategy, this leads us right into the leadership changes and the strategic shifts. Really big stuff happening there.
Absolutely. The arrival of the new CEO, Lip-Bu He'd only been in the job for 5 weeks when this earnings call happened. Talk about hitting the ground running.
Yeah, no kidding. Jumping right into the deep end.
And he was pretty blunt in his assessment and his mission, wasn't he? Turn the company around, regain market share, achieve sustainable growth. That's the stated goal.
And a huge focus, it seemed, from the call was on culture, actually changing how Intel works internally.
Totally. He talked quite openly about organizational complexity, bureaucracy, things just slowing them down, resulting in slow decision-making, teams maybe working in silos.
So the plan is what? Simplify processes, empower smaller, more agile teams, increase transparency and accountability.
Pretty much sums it up. And one of the first sort of concrete structural steps he took was flattening the leadership structure significantly.
Right. Now all the key functions report directly to him, right? Product groups, manufacturing, major administrative functions.
The idea being get closer to the engineering core, speed up decision-making, try and close that competitive gap faster, more direct lines of communication.
Makes sense on paper, definitely. This whole efficiency drive, it also shows up quite clearly in the financials, right? Especially the cost-cutting plans.
Oh yeah, very visible there. They've lowered their operating expense targets. For calendar year 2025, they're now aiming for $17 billion in OpEx, which is down from their previous expectations. And looking further out, targeting $16 billion for 2026.
And CapEx, too. The spending on future growth, new factories, equipment.
Yep. They also trimmed the growth capital expenditure target for 2025, brought it down to $18 billion from a previous target of $20 billion. They cited finding operational efficiencies as the reason for that reduction.
Okay, so cutting costs, streamlining. But there's always that question, isn't there? Does reducing spending, especially CapEx, risk impacting their ability to innovate or make those crucial long-term investments needed to really compete?
That's always the tightrope walk in these situations, isn't it?
Yeah.
You need to save money now to improve the bottom line, but you absolutely need to invest heavily for the future, especially in a capital-intensive industry like semiconductors. It's a balance.
And then there was the other big operational change announced, the return to office mandate.
Right. A new policy requiring employees back in the office 4 days a week, mandatory, starting in Q3 2025.
And the reasoning given was centered around teamwork, fostering collaboration, sparking innovation, basically needing people physically together more often to drive efficiency.
It's a trend we're seeing across parts of the tech industry, for sure, but still a significant cultural and operational shift for Intel's workforce.
So, okay, looking at the overall priorities under this new leadership, what really stands out from the call?
Well, first and foremost, maybe a renewed, intense emphasis on just building best-in-class products. Lip-Bu kept coming back to the idea that best products always win. Seems like a core belief.
Kind of a back-to-basics engineering focus, almost.
Sort of feels that way. Second, refining their AI strategy, with a particular focus on what they see as emerging areas, things like reasoning models, agentic AI, and this term they use, physical AI,
Right.
and crucially, being open to strategic partnerships to get there.
Okay, products, AI, what else?
Third, a big emphasis on building trust with their foundry customers. really recognizing that Foundry is fundamentally a service-oriented business. It's built on yield, reliability, hitting deadlines, meeting very specific client needs, that say-do ratio concept you mentioned.
We'll definitely come back to that say-do ratio. And fourth,
And finally, strengthening their financial position through the cost management we talked about, but also by actively monetizing non-core assets, selling things off. Interestingly, they decided not to fully spin off Intel Capital, their venture investment arm.
right. Instead, they'll selectively invest, but also actively sell off parts of the existing portfolio over time.
Exactly, monetizing parts of that portfolio, plus obviously the big planned sale of the majority stake in Altera, all aimed at bolstering the balance sheet.
Okay, so that's the strategy shift in motion. Now, looking immediately ahead,
Yeah.
Q2, what's the official outlook they provided?
Well, it's pretty cautious. They're guiding for a sequential decline in revenue compared to Q1. The forecast range is $11.2 billion to $12.4 billion.
Which is what, roughly down 2% to 12% from Q1? That's potentially a fair drop quarter over quarter?
It is. And digging into the segments, they expect revenue from DCAI, the Data Center and AI group, to decline at a faster rate than the CCG, the client computing side.
Okay, so data center weaker than client in Q2 and foundry revenue.
Also expected to be down sequentially. They mentioned a couple of reasons. Those Q1 pull-ins, basically, some orders that might have landed in Q2 got fulfilled earlier in Q1.
Borrowing from Q2 demand a little bit.
Kind of looks like it. And also ongoing capacity limitations with their Intel 7 production technology.
Right.
That's slightly older process tech.
Still having capacity issues on Intel 7. That's interesting. Suggests maybe demand is okay there. And the all other segment for Q2.
That part is projected to remain fairly stable, roughly flat sequentially. So the main sequential drags expected in Q2 are Data Center and Foundry, plus some continued decline on the client side.
And profitability expectations for Q2. Gross margin, earnings per share.
They're forecasting a non-GAAP gross margin of around 36.5%. That's noticeably lower than the 39.2% they achieved in Q1.
And why the expected drop in margin?
Primarily due to the anticipated lower overall revenue level. And also likely a shift in their product mix towards some outsourced products, which might carry lower margins, and potentially lower margin client products as well.
Makes sense with lower volume and mix shifts. And the bottom line, EPS.
Their non-GAAP earnings per share are projected to be roughly breaking, basically $0 per share.
Wow, okay. Break even. That's certainly not a strong profit number. And it's interesting that they gave a wider than usual revenue range for Q2, wasn't it? $11.2 to $12.4 billion is a $1.2 billion spread.
So they did acknowledge that, yeah. And they specifically pointed to the current uncertainty swirling around trade policies and increased regulatory risks as significant factors creating volatility in the overall economic environment.
So essentially hedging their bets a bit because the macro picture is just so murky and hard to predict right now.
Seems very much like it. They explicitly mentioned this heightened uncertainty also raises the possibility of a broader economic slowdown, which just makes it much harder to forecast their revenue with the usual precision.
Which really ties directly into some of the bigger, broader trends and challenges that Intel is currently grappling with, doesn't it?
Absolutely. That unstable economic landscape is probably challenge number one. You've got shifting trade rules, persistent inflation in some areas, increasing regulatory scrutiny globally. It all contributes to market volatility and uncertainty for planning.
And the potential impact of tariffs? Is that a specific named concern?
They did mention it, yeah. How potential tariffs could impact both their total addressable market, the size of the pie they're going after, and also their overall operating costs. It's definitely a factor they're watching.
And internally, you've mentioned those Intel 7 capacity constraints again. It still feels a bit surprising, doesn't it, for what's now an older process node?
It is a bit counterintuitive. They said demand for some of their older generation products, the ones based on Intel 7 like the Panther Lake chips, is actually holding up quite strong. The thinking seems to be it's driven partly by consumers being more price sensitive in the current economy and also broader macroeconomic concerns. Basically, people may be opting for more value-oriented or proven options.
So strong demand for older, potentially lower margin stuff is actually causing a manufacturing bottleneck on an older line. Interesting problem to have.
Yeah, it has knock-on effects. And on the flip side, the newer stuff, AI PCs. Adoption rate in Q1 was apparently slower than they initially anticipated.
But they still expect that AI PC wave to build momentum through the rest of the year.
That's the stated expectation, yeah. Plus, of course, they're constantly dealing with intense competition, particularly in the lucrative data center market,
Okay.
including the growing presence of ARM-based solutions from various players.
Right, and that brings us back nicely to that phrase the new CEO used, the say-do ratio. Why is that specific phrase so important for Intel right now?
Well, Libutan really hammered this point home on the call. Intel absolutely needs to deliver on its promises consistently. They need to rebuild trust with customers, with investors, with the market. They've faced criticism, sometimes quite sharply in the past, for over-promising and under-delivering, right?
Yeah.
Product delays, roadmaps, slips.
Yeah, that credibility gap has definitely been a challenge for them at times. So the focus now is heavily on execution above all else.
Exactly. Action speaking louder than just announcements or roadmaps, delivering consistently.
Yeah.
Okay, let's maybe circle back specifically to the foundry business for a moment. What were the other key takeaways there beyond the financials?
Well, the absolute top priority, no question, is getting Intel 18A technology up to speed and manufacturing ready. Ramping that process is job one. The goal remains supporting that first Panther Lake chip built on 18A by the end of 2025, with more products following in the first half of 2026.
And it's not just about getting the technology working in the lab, right? It's the whole manufacturing and service aspect for external customers.
Absolutely. They talked a lot about focusing on improving the yield, how many good chips they get per wafer, and the reliability of their manufacturing for these potential foundry clients, and also fostering a really strong customer service mentality within that whole division. They know they need to think and act like a dedicated service provider.
And are they setting clear targets and metrics? Like for 14A, the process generation planned after 18A.
Yeah, they mentioned they're already actively collaborating with customers right now to define clear performance metrics or KPIs, key performance indicators, specifically for the on-time delivery milestones for their next generation Intel 14A process. So trying to plan ahead and set expectations early.
Good. And did they confirm the plan for Panther Lake, how much of it will actually be built in-house on 18A versus maybe using external foundries?
Yep. Michelle Johnston Holthouse, who runs that side, confirmed their plan is still to manufacture approximately 70% of the Panther Lake chip die area in-house using their own 18A technology.
Nice, so mostly internal for Panther Lake.
Yeah.
And looking even further down the line to the generation after that called Nova Lake.
That architecture is planned to leverage both TSMC's manufacturing capabilities and their own internal Intel processes. It's going to be a mix. But she did note that they expect a larger proportion of Nova Lake wafers will be built internally on Intel process compared to Panther Lake.
Oh, interesting. So still strategically using TSMC where it makes sense, but gradually increasing the internal manufacturing load for their own products over time as their leading edge nodes mature. That hybrid IDM model, truly in action.
Exactly what it looks like. Now, what about the specifics of their approach to AI? We touched on it with DCIR results, but any more detail on the overall strategy?
Well, their stated strategy seems increasingly centered on these, what they call emerging AI workloads. Things like reasoning models, AI, that can actually draw inferences and make logical connections, agentic AI, I think AI systems that can autonomously plan and perform complex tasks. And this concept they keep mentioning, physical AI, which likely relates to AI interacting with the real world through robotics, autonomous systems, edge devices. Maybe less focus on just raw training performance for today's massive language models.
So maybe trying to find the next wave of AI growth or differentiate in specific niches.
Perhaps that's the angle. And they explicitly expressed a strong willingness to form partnerships, both to develop specialized AI silicon tailored for these areas, and also to optimize software stacks, acknowledging they can't, or shouldn't try to, do everything themselves in AI.
And edge computing and inference came up too, right?
Yeah.
Running AI models locally on devices rather than always in the cloud.
Big time. They clearly see edge, AI, and inference applications as significant growth opportunities. And they mentioned they're actively exploring low-power chip designs specifically to address the needs of those markets. It all seems to fit that workload-first philosophy they described, tailoring their AI solutions to specific AI tasks and environments, rather than just building one-size-fits-all general-purpose AI hardware.
Makes sense. And what about their own high-profile data center AI chip that's been talked about, Jaguar Shores? Is that still happening? Is it on track?
It's still on their roadmap, apparently. But they were perhaps a bit vague on the call about specific timelines or updates. They essentially said they plan to share more detailed information about their broader AI roadmap, including Jaguar Shores, sometime in the future. So, watch this space, I guess.
Okay. Anything else noteworthy on the AI front? Mention of IPUs, optics, Anything tangible?
Yeah, they did highlight the progress they believe they're making with their IPU products. Those are their infrastructure processing units. Chips designed to offload and accelerate networking and storage tasks in data centers, which is increasingly important for large AI clusters. And they also expressed optimism about the crucial role of optical interconnects, high-speed light-based connections, and building out the massive scale of future AI infrastructure. They see optics as a key enabler.
And they actually landed a specific large custom AI deal recently.
They did mention that, yes. Securing one significant custom design win in the data center AI space, interestingly, using their traditional x86 architecture as the foundation. So perhaps showing that x86 can still compete effectively for certain AI workloads or custom solutions, even in this rapidly evolving market dominated by GPUs and other accelerators.
Okay. So the AI strategy is definitely evolving. It seems focused on specific emerging areas, open to partnerships, and still leveraging x86 where possible. Let's pivot back to money again. That theme of financial discipline seems really central to the turnaround plan.
Absolutely. It came up repeatedly. They are clearly committed to strengthening their balance sheet, making the company financially more robust.
Primarily through the previously mentioned cuts in operating expenses, OPEX, and capital expenditures,
Right,
CAPEX.
those are big levers.
Hmm.
But also very actively by selling off non-core assets to generate cash. The sale of a majority stake in Altera to Silver Lake is the biggest example right now. That deal is expected to close in the second half of 2025 and should bring in approximately $4.4 billion in cash directly to Intel.
And alongside that, the Intel Capital decision, not a complete spin-off, as some had speculated, but instead a plan to selectively sell off parts of its existing investment portfolio over time.
Exactly. So generating cash from various places, operational savings, asset sales, portfolio monetization. And what's the ultimate stated goal of all this financial maneuvering?
Their stated goal is to begin deleveraging, meaning actively start reducing their overall debt load starting sometime in 2025. Basically, get the company's finances into a healthier, more sustainable position.
Makes perfect sense for a company navigating a major multi-year turnaround effort.
Okay.
So maybe bring it all together now. What was the longer-term vision shared by the new CEO, Liputan, looking beyond just the next quarter or two?
I think the main overarching message was one of managing expectations, setting the stage that this is not expected to be a quick fix. He explicitly told investors they should brace themselves for a multi-year turnaround effort. No overnight miracles.
Right, no magic wands were promised here.
Definitely not. He laid out what he sees as the key metrics for gauging their progress over time. Things like, are they consistently building best-in-class products again? Are they delivering those products on schedule, hitting their roadmap commitments? Are they achieving superior power efficiency, which is increasingly critical? And are they consistently meeting the specific requirements of their key customers?
Back to those fundamentals again, really. Execution, product leadership, customer focus.
Pretty much. And he also specifically reaffirmed their commitment to maintaining a balanced approach with their integrated device manufacturing IDM model, meaning they will continue to heavily leverage their own internal manufacturing capabilities, especially their leading-edge nodes like 18A, while also strategically partnering with external foundries like TSMC where it makes sense for specific products or nodes, not going all in one way or the other.
Right. Trying to get the best of both worlds, leveraging their unique internal strengths while maintaining flexibility and access to external capacity and technology. Okay, so let's try and quickly summarize the absolute key takeaways from this deep dive into Intel's Q1 earnings and strategy update.
Okay, so first, the Q1 results themselves, they actually exceeded Intel's own expectations across the board, revenue, gross margin, and earnings per share, which was, well, an interesting positive data point given the broader context.
But that positive surprise was immediately followed by a much more cautious outlook provided for Q2. They're guiding for lower sequential revenue and basically break-even EPS, largely pinned on the uncertain economic climate, potential impacts of trade policies, and some internal factors like those Intel 7 capacity constraints and foundry pull-ins.
And strategically, it's clear there are significant fundamental shifts underway, driven by the new CEO's intense focus on streamlining operations, reducing organizational complexity, cutting costs, and really trying to reignite innovation and execution discipline across the entire company. It feels like a major overhaul attempt.
Yeah, the flattening structure, the cost targets, the return to office mandate, the renewed focus on foundry execution and building trust, refining the AI strategy, the push for financial discipline with asset sales.
Hmm.
It really is a lot of change happening simultaneously.
And threading through it all, The leadership has made it crystal clear that investors and observers should view this as a long-term journey, a multi-year effort to regain their position as a clear market leader in critical areas.
Right. Definitely managing expectations. No illusions about achieving a quick fix here.
So, with all of that swirling around, here's maybe a final thought for you, the listener, to consider as you process all this.
Okay, yeah. What's the question?
Given everything we've discussed, the really dynamic and uncertain economic environment, the fierce competition, and Intel's own ambitious, complex transformation plans under new leadership, what single factor do you believe will be the most critical, the biggest determinant of their success over, say, the next 18 to 24 months?
Is it just down to raw product innovation? Like, can they truly deliver compelling leadership products in crucial areas like AI, data center, and next-gen PCs? Is product king above all else?
Or maybe is it the foundry execution piece? Can they really make that incredibly complex Intel 18A process work reliably, deliver it on time with good yields, and actually convince major external customers to bet their own futures on Intel manufacturing? Is the foundry success the linchpin?
Or perhaps it's more external than internal. Maybe their success hinges most on their skill in simply navigating the increasingly turbulent global economic and political landscape, dealing with trade issues, regulations, macroeconomic headwinds.
Exactly. What's the single biggest lever or risk? Product innovation, foundry execution, or navigating the macro environment? Something to think about.
It's definitely a complex equation with a lot of interdependent variables. We encourage you to think about these insights and form your own view. And hey, if you really want to get into the absolute nitty-gritty details, exploring the full earnings report or the earnings call transcript itself would be a valuable next step.
Absolutely. Well, thanks for taking this deep dive with us today.